Today, welcome to the webinar. We're talking about FP&A Brass Tacks. This is really kind of advisory services, CAS advisory 201. And we want to really lean into a lot of the advanced FP&A methodologies, what advisory looks like on a whole new level. This is going to be a pretty good deep dive that a lot of you on this call will be able to take things and tactically put them into play, or at least start a conversation for your firms. So I will start off. I'm Fady Hawatmeh. I'm a former outsourced CFO. I started my career off at Boeing in FP&A and strategy. After Boeing, I did oil and gas consulting. After that, I started my outsourced CFO consulting firm simply because all my friends kept getting my free financial advice, and I said, I'm going to start charging you now. So fortunately, that allowed me to build a pretty cool practice for about 5 years before going all in on Clockwork. And I'm joined with my good friend, Michael.
Hey, Fady. Thanks for having me on. I'm Michael Lee, CEO of Reconciled, and I started my career in bookkeeping in small businesses and nonprofits, climbed my way up to the CFO seat in my mid-20s, and then launched Reconciled about 10 years ago. We're celebrating our 10th year this year, and have known Fady for several years now, one of the earliest customers of Clockwork, but also a big fan of just him as a human being and a friend. And really excited about this topic, mainly because Fady comes at it from working at really large organizations as well as helping small organizations. I really come at it from a practical standpoint of the small business owner, entrepreneur, what practically works. And so whether you work for clients that are big or small, I think you're going to get a lot out of today's webinar. But looking forward to everything we're talking about today.
Yeah, love it, love it, love it. So again, thanks everyone for joining. Super stoked about this topic. Really, we're covering the 201 of FP&A with a focus on teams that have an established CAS offering already. If you've joined and you don't yet have a CAS function yet, you don't have to leave. Aaron will actually drop our brand new ebook, our CAS ebook, into the chat. That's a very CAS 101. It gives you all the foundational data and infrastructure around a CAS department, CAS function, CAS organization. So I would honestly check that out as well, and see if you can get value out of that as well as this call. So with all the boring stuff out of the way, let's get started. Really, today we're going to be covering 5 major FP&A topics. And the first one is going to be architecting comprehensive financial insights. Like, how are you actually going to provide the financial insights for your clients? Then we're going to talk about some of the frameworks around reporting. Then we're going to get real nerd about cash flow forecasting, balance sheet forecasting, really elevate into that advanced level. A lot about custom metrics, custom KPIs. How are you actually delivering things for your clients that they can actually look at benchmarking and look at other sources to improve their company based on the economy and based on what they're seeing across the board? Then we're really going to get into the scenario planning advanced portion, more than just good, better, best. We're actually going to talk about some sophisticated scenarios. How are you building them? How do you manage them? How do you maintain them? How do you update them? And everything in between. So in each section, our guest expert, Michael, will give kind of a rundown on the strategy. How do you organize it? How do you structure it? How do you actually get it going? And then I will actually dive in from a tactical side and actually give you tactical tips that either you or your team can use. And of course, I have Erin here, my VP of marketing. She will make sure that we're watching the chat, addressing any Q&A. So if you have anything, literally, please feel free. Do not hesitate. Put it in the chat, put it in the Q&A section. We'll either go through it literally as we're going, or at the end. We saved a good chunk of time to address as many questions. And we know a bunch of you already sent in questions with the pre-email, so we'll make sure that we try and cover those. All right. So, section 1, architecting the comprehensive financial insights. So, Michael, I'm going to kind of kick it to you. Like, I'm curious from your perspective, when you work with growing firms, and you've obviously built several really successful growing firms, and congrats on the 10 years with Reconciled. What's your thought process around creating kind of the big picture financial insights that most importantly actually get used by clients and by your clients rather than just ignored?
Yeah, that's a great question. So the first thing I want to recognize is that most of the people on this call, and us included, we're numbers people, right? We love looking at numbers. We are educated in it. We've done it for our whole career. And we assume that the excitement and passion around those numbers are held the same by business owners, entrepreneurs, C-levels. And the reality is that's far from the truth. Most individuals, whether it's from their personal life or professional career, are at best somewhat familiar with numbers and at worst really scared of them. And so the key in regards to financial insights is always the 80-20 rule in my example or my assumption. And in this sense, the 20-80 rule. What's the 20% of the numbers or insights you can give that actually make 80% of the impact for that client or person you're looking at? And here's why I know this. Most firms that deliver monthly reporting packages or quarterly reporting packages to their clients, almost all of it never gets opened. I would argue 80-90% of it never gets opened. Email, the PDF that they send, the write-up, whatever you want to call it. It used to be called write-up. It never gets opened. It never gets read because most individuals, they're making decisions based off of just very specific information, whether it's a department area and they're only looking at certain information or whatever they're incentivized to do for their part of the company. So when you think about financial insights for your client, depending on who the client end client is, whether it's the CEO, the owner, the CFO at the client, the COO at the client, or maybe it's a director or manager, you need to really be thinking about and understanding what is the financial insight that actually matters to them. Okay. Are they incentivized on revenue growth? You need to be reporting revenue growth and revenue in its variety of ways and highlighting that very importantly. Is it EBITDA and is it cash flow? You need to be taking a look at that. Is it unit economics? You need to be focusing on gross margin and unit economics per product or service line, right? So financial insights as a whole is really understanding what matters to your client. And how do you know what matters? You have to ask. You have to ask and actually build a relationship where you understand what drives the business, what drives them as the individual in their role, and then provide that insight at first and front and center, first and foremost. And ultimately, that's where I think about the philosophy. Again, we as accounting professionals and finance professionals get super excited about all the other numbers, all the financial statements. And we forget that you want your client to actually open and look at this stuff. And 95% of the things we're providing aren't being looked at by most clients because firms are providing everything there thinking, oh, the client wants to see everything. And the reality is they don't even look at it. Now, can you have the reports uploaded somewhere for their access, for their history, all stuff? Of course. But really hone in on what is the 20% of items on those insights, on those lists that make 80% of the impact and help them make 80% of decisions for their business.
Yeah, I mean, I agree on all that. I can't tell you how many times I've spent hours building a financial model, and I feel like such a badass that I spent and built this elaborate financial model, and I send it to them, and my clients literally don't open it, and then they'll come back to me with a super simple question. So, kind of tactically, right? Getting into the financial insights. When we think about tactically delivering the financial insights, I think, Michael, you hit the nail on the head. Understand what your clients actually care about. What do they actually want to see? Why are they hiring you? Why are they working with you? But there's two kind of ways that we're going to walk through a lot of the tactical. We'll share this is a no pitch zone. So we'll share the Excel way because that's how I did it before Clockwork, and then we'll share what you should be looking for on the software side. And so on the Excel side, it's super, if you don't have a bunch of clients, you don't have a bunch of resources, you don't have a lot of people to be doing, like, Excel's great. It's very simple. It's very easy. Nothing will ever replace Excel. We never say that we're going to replace Excel. We replace a lot of it, but there's always pros and cons on providing the stuff in Excel because like I said, I can count on one hand the amount of my clients that have actually appreciated all of my Excel jockey skills for what they were and not everything that I added on top of that. And everything you add on top of that's why they hire you. That's why you exist. That's why we exist. And on the software side, it's super important. Like when you're building the building blocks of financial models, of financial insights, doing all that kind of stuff, like make sure that if you want to scale, you have to be leveraging software. And then there's no other way to put it. That's like a firm staying on QuickBooks Desktop, but saying that they want to build an accounting firm. You have to be on QuickBooks Online. You have to be on Xero. You have to be on one of the other softwares that allow you to scale the accounting side, especially if you're trying to add on top of that. And really make sure and understand you have a structure of how things should be structured and when things should be structured and how they should be done well, spending time on internal and external collaboration to make sure that everyone's structured around building the financial insights that your clients actually care about in a very unique and quick way, and making sure that you're not just using software just to use it, and you're not just using Excel just to use it, and you're not just because we've used it all the time and because we have this template that we have. Like those are very, very dangerous traps to fall into and to stay in when you're building out the architecture of providing those financial insights.
Yeah, I totally agree, and it's really important too because as you build your team out, the rest of your advisors, you don't want your advisors coming in with their own models that you then have to learn
Yeah.
multiple models
Yeah.
by client by advisor, and that's what happens in the early stages of a small firm. You have your model, and then you hire an advisor; they have their model, and you're so used to it because, like you said, Excel is great. It works
Mhm.
fast if you're efficient at it and you're comfortable with your model, but the next person isn't. And
Mhm.
so using software for scalability is really important. And I like the differentiation you're putting here.
Yeah. Awesome. Love it. So the next one, right? The reporting kind of the building blocks of reporting of the financial models. Like what do you actually need to build the financial models? Like these are some very, very simple things. Like you need the assumptions from your clients. Your clients have to give you an understanding of what their assumptions are. Assumptions are growth rates. Assumptions are product assumptions, how much they're going to grow that year, whether they're going to hire people, whether they're going to fire people, whether they're going to get more funding. All the assumptions, all the what ifs that your clients kind of think of, those are all their assumptions, right? Making sure that you're incorporating every assumption and building it in a scalable way. Because one of my mistakes that I did at the early stage, I'll kind of hard code assumptions, hard code numbers. I'm like, oh yeah, 10 grand, 15 grand, 20 grand, whatever. Then when I come back to it, I'm like, shoot, where did this number come from? And then I go and ask the client, good luck. They're not going to know. They're going to be like, I don't know. Where did that come from? So making sure that you have the variable assumptions that you can actually play with. And then garbage in, garbage out. If you don't have accurate actuals, you don't have accurate financials, you're never going to have an accurate financial model. It literally does not matter. A lot, especially for startups, a lot of companies will always say like your financials are a shit show until you're a Series B. Like that's that's a quick way to never get funded. It's a quick way to never get bought. It's a quick way to never have any merger or anything like that. Your books have to be in order. They have to be in line. They have to be accurate to make sure that your projections are accurate and in line because you can't say that we're going to go from $10,000 to $70,000 just out of nowhere, right? And then as you're actually working towards, like when your clients come to you and they give you assumptions, because you have the accurate actuals, because you have accurate projections, you can kind of call bullshit on their assumptions. If a client says, "Oh, we're going to kill it and we're going to blow up this year," you can very much go and tell them, "Listen, that's probably not going to be responsible or accurate." But if they are, and they are actually blowing up, your variance analysis on a monthly, quarterly basis is going to be the leading indicator on are they actually going to blow up? Are they actually doing what they thought? And if you're not looking at a variance on a regular basis, I know historically, like doing a BVA, budget versus actual, is a nightmare in Excel, and updating it, and then you have to deliver it to your clients. And again, clients don't even open it, so you're giving them something else. But if you don't have that variance analysis on a weekly, monthly, quarterly basis at the latest, like you have to make sure that your clients understand the gap of what they have to perform at, what they said they're going to perform at, and everything kind of getting to that point, because then they can be tactical about, we need to make more money, we need to sell more stuff, we need to stop spending, we need to cut costs, whatever it may be, on a very regular basis. With Excel, like this is a simple view of a financial model, right? It's simple. Excel is great. Export a P&L out of QBO, put it into Excel, reformat some stuff, have your actuals there, add the columns for the additional years, and that's your forecast. That's literally your financial model. There's nothing, it doesn't have to be this massively robust and complex thing. If you have clients that are simple, like you can provide them a financial model, just do a growth rate, you can get them something pretty quickly, right? It doesn't have to be elaborate, but it's still Excel, right? It still looks like this. You send this to anyone, no one's really going to get excited about it. But when you're actually looking at kind of your actuals, right? You have to make sure that reconciliation, right? Michael, you started on the bookkeeping side. You started on that, like getting that stuff, doing the data validation, making sure that things are structured. Like, talk a little bit more, if you can, from your perspective, like how often were you doing the books? How often were you doing reconciliations? How often were you kind of validating all the data that was coming in on your side to make sure the actuals were accurate?
Yeah, it's it's super time intensive. And when I was doing most of the advisory at the start of Reconciled, I would be spending hours just validating because I didn't want to look dumb in front of the client.
Yeah.
I didn't want to send the client the wrong shell sheet. And there were multiple times where, I mean, I send it and then I catch an error later and I go, oh my gosh, I
Yeah.
have to resend this. And I don't know what decisions the client's made on the way
Yep.
in
Yep.
between me sending it and catching it. I don't know who he's shown it to or who they've forwarded to. So reconciliation is a big piece in validating the data, making sure all the equations were correct, making sure that it was tying to the right assumptions on the right spreadsheet, on the right workbook, and also you're hiding certain workbooks because you don't want the client to see certain
Yeah.
assumptions, certain workbooks. So, and you know, the image that you showed is a great example. Even that for us is a simple sheet. I would send something what I thought looked pretty simple, and it was still confusing for the client. I'd
Oh
have to
yeah.
walk through, hey, look here first, then look at this sheet, then look at this sheet. And so there are some limitations on even the most simple spreadsheet, because you do want to highlight and you want to really hone in on here are the things to really pay attention to. And that takes work to remember to do that. It doesn't
Hmm.
stop at, hey, the data's accurate.
Yeah.
It really starts, you know, that's like table stakes. They're going to assume the data is accurate. Your client's going to assume the numbers are right.
Yeah.
Now it's what do you want them to look at and what action should they take, or do you advise them taking from that?
And that's the key. Like they're going to assume it's right until it's not, and then you
Right.
lose all credibility. But you have to make sure that you're advising them. When you look at kind of shifting gears a little bit now on the reporting side, right? And Michael, obviously, a lot of people fall into the pattern of sending clients some detailed reports and data packages and blah blah, all these stuff. They're not actionable. And how are you, literally what we were just talking about, how are you taking that client relationship from just delivering and throwing things over the fence that you think they're going to look at? Because, we share a model. We, as finance and accounting people, we can look at it and be like, yeah, that's a model. This is how you decipher it. But you send it to someone who doesn't have that background, completely glazed eyes, and they're like, I don't even know what to do with this. So how are you transforming your relationship with your clients and delivering the clear decision ready insights with advice, with actual advisory, to help your clients achieve their goals?
Yeah. So here's kind of 3 to 5 simple things you could do as an advisor to make the reporting framework more actionable and easier for client. And you may want to do all of these or just one of these, depending on the size of the advisory agreement or scope you have with the client. So for the small client, for the small advisory client, you've really only committed a couple hours a month to them, and you only have time and capacity and scope for that. Well, what can you do in an email and a recorded video that just simplifies 3 to 5 top points from the financials? Okay, you say, here's 3 to 5 things I want to highlight and for you to take a look at. And from these 3 to 5 items, here's the action I recommend, or the question you should go back to your leadership team or your company or your staff with. So, for example, it could be, hey, I'm noticing that there was a decrease in the sale of this specific product or service line, and the revenue reporting for the quarter or the month has dropped. Let's talk about that on our next call, or please go and do some research and get back to me on what happened there. Did you guys try to do a sale, or did something happen with the product, or did you have a large amount of returns and you're posting it to that revenue line? What is it that happened that's causing this problem? Did you pull it off the shelf? That's example of an insight. But you do that in a email summary or a Loom video, and you highlight it. Now you can have all the other numbers and data you want as like exhibits or attachments or addendums, but highlight that in an email and literally do a recorded Zoom video or a Loom. You go to the medium-sized client. Okay, the medium-sized client, you're doing a little fuller scope. Maybe you're doing a chart or a graph. So you send them the spreadsheet, but you have a chart or a graph highlighting a trend, or you're highlighting a change that you think is really important for them to see, and you have 2 or 3 other ones, and you're doing that in a chart or a graph or a picture or an image. You might also include a video, and maybe you do a 15 to 30-minute call with them. Now you go to the larger client. When I think of the larger client, I think of the client where you're going to do an hour sit down or video call with them, and it might be once a week or once a month. That's a lot of your time because you're prepping for that call. So you want to set up and prep for that call. You want to have the 3 to 5 action items. And one of the things I recommend is on every call, you have an agenda. You send it ahead of time. Don't make it like, what are we going to talk about? You drive that meeting and you say, here's the financials I'm going to present. Here are the 3 to 5 items we're going to talk about. And I want some action items. And here are the ones I'm going to recommend. But you also might have 3 or 4 questions you're going to ask the client to say, here are the questions I want to ask you to help you make a decision that's going to be really important. And based on what you know about the business and the client, based on your interactions with their bookkeeper or their operations leaders or whoever, you go, okay, here are the questions I'm going to ask. So you're going to set up that call for it to be very, very actionable. And when they leave that call, you're going to have some homework, right? So you're going to say, hey, based on this call, here's what we reviewed. Here's the action items I promised and you promised, and I'm going to follow up with you in 1 week, 2 weeks, 3 weeks, or the next call. So that's really important. You leave with something that they know they have to do. It's not just, okay, thank you for the insight, bye-bye. It's like, no, what I'm going to follow on. I want you to make action. I want you to take action on this. It could be a change on pricing. It could be a change on, hey, I'm going to go back and check with my operations leader on it. Whatever it is, you want to have that because now the client sees, one, the report was meaningful, the action was meaningful, and you're actually driving actions for them to implement what they're learning from you in that call or from that insight.
All that is so spot on. And I think the most tactical thing there is 3 to 5, 3 to 5, 3 to 5. It does not take much. Like adding value, just do 3 to 5 points, 3 to 5 observations, 3 to 5 things, and just build on those as you get with the complexity of a client. All that is, this is why you're on the Inc. 5000 fastest growing 2 years in a row. All right, diving into the tactical, right? Like when you're actually looking at the what and the why, like you have to make sure you're asking yourself and your team, what are we looking for? Why are we looking at it? What do we want to do with it? You have to dissect the financial model to really find like the relevant data points for the story to your clients, right? You have to find the story, and your clients don't care about your formulas. They're not going to look at the cells, and they're not going to look at the different things that you have. They want to know the assumptions that are being considered and factored. but they're paying you for your expertise, not because of your formula building. And that's super foundational, and it's very easy for us to be like, oh yeah, duh, but we forget it all the time. There's been so many times where I had that exact same trap. I'm like, look at my model, look how great I am, but I didn't actually add the 3 to 5 of what they should do and then I'm like, oh shoot, I'm probably not doing what I need to be doing. So you look at kind of an example, right? Like your 25% to plan. Like, why are you there? Like, your assumption is off. You sandbagged your numbers. You aren't reporting them correctly. You aren't doing things the right way. Like, that's why they're paying us. That's why they want us to actually go into don't just throw them a report and be like, hey, you're 25%. See you later. We'll talk to you in a quarter. Like, why? Why are you there? Make sure you're driving that. And when you're looking, if you use Excel, VLOOKUPs are your best friend. I remember when I started at Boeing, I'm an old man now, but when I was at Boeing, I entered my team and they didn't know what VLOOKUPs were because I joined a team. It was a team of 4 people that were all older. And they were like, oh, yeah, we run all these reports and we do all this and we update this manually. And they gave me this huge thing of what I should do. And I'm like, have you guys not heard of VLOOKUPs? And I did, and they thought I was like a wizard. Like VLOOKUPs are super, super simple, super easy to use, but it's a very easy way to provide variance kind of looks for your clients. Just use a VLOOKUP and then ask yourself, what does this solve? How are we actually delivering that value? And these are, Excel, again, people aren't paying you for your Excel skills, but this is some very, very tactical, very simple things. Like you can literally build these formulas, take these formulas and put them in to a cell and have them reference the right numbers in the right columns. And it'll tell you your variances. It'll give you the variances that then you get to take and actually deliver to your clients and say, these are the variances. What happens here? Why are we tracking? What are we trying to do from that perspective? And it's not too complicated. And the next thing, which is the how and the why and the what, have actual tolerance thresholds. For my clients, I ran a very, very tight tolerance. Anything that was above or beyond 10%, I demanded a variance analysis on. I told my clients, like, why are you 10% off? Good or bad? 10% up or down, even on the revenue side, it's a bad thing. That means you under forecasted your numbers. You sandbagged your numbers. Like, why did we sandbag? Did a deal come in at a higher price that we didn't think about? Or are we legitimately just sandbagging numbers? Having a tolerance, you can literally build a conditional formatting in a cell that will highlight different colors based on the tolerance on that variance. Again, super simple, anytime you want to look at financials, just update them, go into this and pull 3 to 5 things and add, this is what I think happened, or that homework that you're going to have a conversation with your clients on, get your answers. And then have your own homework. Like, hey, if this continues, we should reforecast, we should adjust the model, we should adjust the assumptions, anything like that. Then, when you're kind of looking at kind of an implementation kind of checklist, right? This is something super tactical. You can literally take this today and have this be your checklist of how you're providing the reporting framework for your clients. And I'm not going to go through them because that's a lot of text for a slide, and you'll never see me have that much text on a slide that I'm actually going to walk through. But screenshot it. We'll send out the slides. But this is a very, very easy checklist to go and deliver what your clients need it. Shifting gears a little bit on the cash flow and balance sheet forecasting. So again, we're going to get super tactical on this side. First off, I want to ask you, Michael, talking about forecasting, when clients don't trust, forecasts in Excel, right? They've been burned before by manual errors, inaccurate models, stale data, fat fingering numbers. Spreadsheets are difficult to collaborate on. Trying to have, V1, V2, V3, V4, you're going to have 75 Vs, and then people are going to start miscounting, double counting, any of that kind of stuff. How do you build accurate forecasting and make sure that that's standard for your clients?
Yeah, so there's 2 approaches that I think that most firm owners, most of the advisors on here can take, and And one of them is generally the common one, and then the other one is one I think is less common but more practical. So the first one is that most of us take historical performance of a business, especially if it's been around for a while, and we take a look at, okay, what are the growth rates, what are the changes that have occurred over the past 3 to 5 years, and then create a growth or change model per line item on the balance sheet income statement that grows. And assuming a steady state of business, and if the business hasn't changed dramatically over the past 3 to 5 years, you can see revenue growth, expense line growth, et cetera, go up. And that makes sense if you have a business that's just steadily growing at cost of living or a little above, and where their expense costs can be predictable at cost of living, and hiring plans are pretty steady. But if you have a fast growing company, and a company especially that is a startup, maybe they've raised venture money, so they're expected to have a hockey stick, you can't take that typical approach. Your historical information is not a sign of the future. So instead, the more practical approach is to think about we'll start with the end in mind. Ultimately, from a forecast perspective, what is the end that the company is trying to get to? And then you create, 2 or 3 scenarios of that forecast. Okay. So let's say the end is we need to see, 50% growth this year. That's a big number for most companies, right? That's not even venture level. That's still slow for venture level, but that's huge for a fast growing company, right? That's huge. Anything above 20% is gigantic growth for most companies. So you have to think about, okay, how do we get to that? What does that end look like if we do the whole year? What are the drivers for that end? Okay, by department, and then what are the resourcing, all those things around that? What variable, if you understand your unit economics really well, and hopefully your unit economics get better over that growth curve, what's driving that? And then what are the fixed costs that are predictable that you know? And so knowing what the end in mind, and also setting expectations with the executive team that, hey, look, the farther we go out, the less percentage likelihood this is going to happen. The closer we are, meaning if it's in the next 90 days, more than likely the next 90 days we can predict with 90%, 95% accuracy, as long as we really understand our drivers correctly, and everyone understands the drivers. But the farther we go out, the less predictable it's going to be, unless you have a unique business where the sales cycle is long and you actually can align the sales and spending cycle to that growth curve. So that's where then being very practical and going, okay, what is it you're trying to get to? And how do we then work backwards to go, how do we truncate each quarter, each month to be realistic? So it's one thing to say, I want 50% growth. It's another to go, can we really get to 50% growth for the year? How do we divide that up by quarter? And then how do we make sure that the sales team, the hiring team, people who are purchasing, everybody that's part of the plan, actually can make realistic decisions by quarter for that, instead of looking at the whole year. And so that then becomes actionable to go, okay, action item says at the sales level, we need 100 proposals going out every quarter. If you know the number, then it's like, okay, sales team, can you do 100 proposals every quarter? If they tell you no, we don't have the people, well, now you have to add more salespeople. Like it becomes very practical in that sense. So that's from a forecasting perspective. But we talk about advanced, cash flow and balance sheet forecasting. This is where, for most people who have not had a deep FP&A experience, balance sheet and cash flow forecasting is actually very difficult for them. The income statement is actually the easiest.
Yeah.
Balance sheet and cash flow, where they start tying together, it becomes very hard. And this is where I see Excel models break all the time because they've got some like give account or fudge account somewhere on accounts payable or in the asset level. And then you see like, oh, everything else is going there. This number doesn't make any sense. So you gotta really make sure that in this area, you're checking for Excel errors, you're checking for assumptions, and you're really tying the financials together, because a QuickBooks or accounting software does this automatically, but in Excel, you actually have to do it manually.
Yeah.
And so this is where it could be error prone. You want to make sure you're double checking this.
And those errors are critical Like
Okay.
you on the income statement, like in the financial model, you can have a mess up. Who cares? Like your revenue isn't, whatever, like it's not but you have an error on your cash flow forecast or your balance sheet. I mean, you're cooked. There's nothing that you can do there. And that was always one of my biggest concerns, and why, quite honestly, why Clockwork exists is because, nothing had all of them together. They always talk about all these different, you have to have a three statement model. Just because you have a three-statement model doesn't mean anything. If they're three-statement and they're tied together, that's what means something. I love that. So when we talk about kind of the forecasting on the, like, it's critical and it takes a lot of time. So I was the CFO COO of one of my clients while I was running my firm, and it was a telehealth company. We were a VC backed company, and I was spending 2+ hours every week updating our cash flow forecast because we had to have a weekly cash flow forecast, 13-week cash flow forecast, and 2 weeks out of the box, right? That's 2 hours every single week updating the cash flow forecast. Then on top of that, I'm spending probably 5 to 6 hours updating the actual financial model, which ties to all the other stuff. So out of the box, you're talking about 10 to 12 hours just of maintenance every single month, making sure that things are good. And the biggest thing is when you're looking at the forecasting of the cash flow of the balance sheet, like you have to track your AR, your AP, you have to track all your bank accounts, your bank reconciliation, make sure that those are all accurate. Then you have to make sure, like you said, Michael, like 90 days out, your sales team should be getting you very, very confident numbers on what they're going to close. Have some sort of probability, 90%, 95%, even 100%. I personally never baked anything that was anything lower than 90% into a pipeline, a cash flow forecast. But make sure that those deals are actually qualified. Make sure that those conversations are actually qualified. Then make sure that all the obligations that you have are being tracked. All your loans, all your lines of credit, all of your revolving anything. Make sure that those are all tracked, because if all of a sudden you have some sort of liability that pops up that you didn't account for, there goes your entire gap or kind of float that you have on the cash side. This is, again, I'm not going to walk through it, but this is a very, very foundational process to build and update cash flow forecasts, right? You want to do this manually, this is what you have to do. You have to do all your banks, all your variance. You have to review your AP, review your AR, do your pipeline, update your forecast. Then you're checking all the stuff. Make sure you have all the things are tracking, all the things are tying. Only thing that sucks in Excel is if you fat finger a number, Excel doesn't tell you you fat fingered a number. If it's supposed to be a 78, but you put an 87, Excel won't tell you that. If you put in a wrong number, it'll tell you that. And so when you're looking at the actual updates, like you have to double and triple and quadruple check that the numbers are the right way. But this process is pretty simple in the sense of, like, what you have to do. It's just you have to have the time and the energy to do it. Um,
Yeah, I was gonna say, go back to you talking about 1 to 2 hours a week for an experienced cast on a new
yeah.
model, especially if you're building a new model or you have a new model that you've inherited. Expect about 3 to 5 times the time for that
Yeah.
first few
Yeah.
weeks. You gotta get really comfortable. So if you know that model, then you're gonna be able to fly through it. But that is, that is like the ideal situation. And
Yeah.
oftentimes you're not sitting at ideal situation most of the
Yeah.
time.
Yeah. You're absolutely right. Yeah. That was literally after I had my eyes bled from how many financial models I had built in my life. It was kind of getting to that point. And again, these are just some super simple error proof models, or literally formulas that you can put in your Excel. If you want to use Excel, if you still use Excel, you can literally use these. Have checks to make sure that your things are tying out. And when you do, Excel is only so good, but you have to manage your AREAP. You still have to manage all your hidden fees, all your auto renewals, all your subscriptions, Even at Clockwork, I can't tell you how many times I'm like, oh my God, we have to pay the HubSpot bill, or we have to pay the, whatever. And then it's like, oh shoot, I didn't factor that in. Or like we did our SOC 2 type 2. Then I'm like, oh shoot, now we have to factor that in for our, like all those stuff impacts cash, and it impacts cash pretty real because those aren't bills that you can just be like, we'll pay it later. It's not the trash bill. And when you look at kind of the software that you're using, like make sure that it has weekly. Like I can't tell you how many times I've tried softwares, tons that do monthly, and they think that that monthly is it. Make sure if you do use a software, it incorporates the financial model to the balance sheet, to the cash flow. You only have to update one. You don't have to map things. You don't have to do anything. It updates real time from your cloud accounting system, and run them parallel. If you have this huge model, this huge thing that you've built, don't just go cold turkey on using a software. I got burned on that multiple times, and I know everyone on this call has probably got burned on that. But like run them parallel. See that you can trust it. See that it's accurate. See that it fits for your use case, and you'll have a much better way to roll it out. Custom metrics. And I do want to make sure we save as much time because Michael, your conversations are phenomenal. And I want to shut up more and let you share more because you're doing awesome. So custom metrics, I'm going to kind of walk through like when you're working through a new client. And a lot of firms, everyone wants to niche and pick your niche, pick your niche. Even if you're industry niche or not industry niche, how do you translate their non-standard data into formats your team can really kind of effectively analyze? And how are you developing and implementing like those custom KPIs that combine the financial and non-financial data that your clients can actually get business insights to make decisions from?
Yeah, I think a great example to use is an industry like the SaaS industry. SaaS industry tracks metrics and financials unlike any other industry in most industries. And you can't generally get SaaS metrics out of an accounting system. It just doesn't report that way.
Yeah.
And so when you're thinking about SaaS companies, what are they driven by? They're driven by their MRR growth rate, their ARR, their churn rates. And so they're wanting to look at what does the growth rate look like on a monthly and quarterly basis of monthly recurring customers? How many customers are they losing every month? What is the customer acquisition cost to get a new customer? So they're trying to understand their total spend per customer, also known as their CAC, right? And how fast can they return that CAC as well? How fast, if they spend it and they get the customer, how fast do they return that money? All that's really, really important. And then the unit economics per customer that drives that business as they grow. So you want to first start with, generally with a SaaS company, they are tracking data in some other system because the accounting systems aren't working for them. And that might be HubSpot, that might be some Stripe, that might be some other billing system. You want to take that system and then translate it into accounting speak or financial speak for yourself or your team, so that you can understand how does that translate into, what does it look like on the income statement? How does that translate what it looks like onto the balance sheet, right? SaaS companies have a large amount of deferred revenue. It's like, again, no other industry, especially if they're pre-selling prepaid packages, whether that's quarterly, 6 months, or annual packages. You'll see this large growth of deferred revenue. For us, we go, well, that's a huge liability. That's a problem. It's like, well, no, that's not a problem in SaaS. They want to have prepaid because that means their cash is going up, and they have a large amount of cash they can continue to go and spend on acquiring new customers going forward. That's the name of the game of SaaS. So understanding in the industry what is the metric that's what's driving the value or the enterprise value of that business, and then taking those metrics, tracking them, getting access to the systems that your client, it may be a non-accounting system, so getting access to that so you can start tracking. And then a lot of the times those systems aren't going to be very friendly on reporting in the accounting way you want. So if you ever try to get a report out of Stripe, it's terrible. Like it's like, and it's been around forever. It's terrible at reporting.
And they're not changing it.
And they're not going to change it because they didn't build it for accountants. They built it for entrepreneurs to do billing and to grow. So you might have to use a middleware tool, a middle reporting tool that attaches to Stripe natively, or use something like a Zapier that attaches it and then translate the data for you in a way for you to format it for custom metrics. But now that you know that, when you come and report to the client, you don't want to use the words you would use. You want to use their language. So
Yep.
start using the word MRR, ARR, growth rate, CAC, churn, LTV. Those are good examples. And if you're going to specialize in SaaS, you got to be talking that language all the time. So that's
Yep.
one of many examples of how do you focus on a niche, take custom metrics in an industry, and then translate it. One, become an understanding for yourself, but then translate it back to the customer to grow, and then highlight where the risk for the client. So, okay, they're focused on LTV and churn and stuff, but if their deferred revenue goes up, and if deferred revenue goes up, and all of a sudden they want to go to a bank and borrow money, the banks might have a problem because they're going to look at it as a liability, right? So there's some other translation that they're going to need from you to go, hey, I get why you're focused on this, but if you want to go borrow a line of credit or something, you might have a challenge here. And
Yeah.
here's why. So those are the translation you have to do for them to help them understand the income statement, balance sheet impact, the accounting speak impact it might have on their business.
Yeah, I love literally all that is phenomenal. And I'm actually going to fly through our kind of the tactical section on the custom metrics because I think you hit kind of everything. We talked about data integrity. You talked about the standard metrics like revenue and margins, the custom metrics. These are some industry specific MRR, CAC, LTV, churn, manufacturing, professional services, some other stuff there that you can leverage. Visuals, people love charts. People love graphs. They love visuals of what that story is. And it allows us as professionals to add the story to the charts and to the graphs. It makes our lives easier. Plus, it makes us look good. Like if you send this to someone, it's way different than sending that Excel spreadsheet we talked about. Metrics, this is kind of some more examples of when you want to tie metrics together, like you were talking about, Michael, like just because your revenue is going up, it does not matter if you're burning a ridiculous amount of money to attract those customers. So always making sure that you're tracking things to tell the full story. That's how you'll actually get an actual picture and understanding of what advisory your clients need and how they can actually grow their business successfully. Software, again, like make sure you can do non-financial and financial. If you want to use a software, not Excel, make sure you can import data or it integrates directly and you have multiple data sources going into the software. Real-time updates, obviously, that's kind of a non-starter. And making sure that you can look at both historicals and forecast all in one place. I think that's always been a big gap where, if you can't look at the where you've been and where you're going all on the same charts, on the same graphs, with all the stuff kind of tied together, it'll kind of leave you with a half a story. All right, scenario planning. And we'll do this. We'll fly through this for a little bit and then we'll leave a little bit. I mean, we have a bajillion questions and I want to make sure we save some time on the question. So this one, Michael, we'll just kind of fly through on the scenario planning. This is the scenario planning. Really, a lot of times people talk about scenario planning like being academic rather than practical. Like, oh, you have to have the best, worst, and realistic. Like you have to have something. But like, how do you make it a valuable exercise that your clients are going through, that your team is going through, rather than just kind of checking the box and saying we've done scenario planning?
One, you want to talk with the client and really understand when they think about the forecast model, what are the actual goals they're trying to hit, and then what incentives align to those goals, and then does it for them? Are they thinking solely about, hey, we only have one goal in mind and we really don't care about the others? We have one goal in mind. If we don't hit it, we're not raising our next round. That's it, right? That could be one example. But help your client think through, okay, what's the realistic goal that you're trying to hit? What's the breakout? Like if you have a stellar year and you could go back to your investors report and go, wow, we had a stellar year. Here's what it looks like. What does that look like? And then hey, what if we just do an average okay year, but it's not great? And honestly, we would be really unhappy. We would be unhappy if we just had this average year. So
Mhm.
those are the ones to me go, what's very practical around it? And then what are the practical variables or measures in which you hit each of those? And every team, every department, every leader should know, okay, yeah, if we get past our sales goals by 120%, awesome. If we hit it 90 to 100%, that's great. Here's if we only do 80% or less on our sales goal. That's an example. And then everything else gets impacted because of that, right? So it's got to be very practical. And that means you as an advisor really understanding their business and understanding the drivers and the incentives around those drivers. Otherwise, creating scenarios for scenario's sake is kind of just a waste of time. It's just
Yeah.
like you're gonna have them, but is management actually going to look at them? Are they going to make changes? And what changes will they make for each one? So that they understand, like, hey, it looks like we're not going to hit we're not going to do the crushing goal. We're going to do we hit our goal target. Well, that means this department have to do less hiring. So you want to have, okay, what are a few changes that are going to occur by scenario for each person as well?
Yeah, I love all that because I've seen so many companies that do scenarios. They're like, okay, we're sales are down 20% or they're up 20%. That's our scenario. Like, no, you have to have actual scenarios. Um, and I'm actually, we're going to do an audible and we're just going to jump straight into the Q&A side. We'll have the slides that we prepared and we'll obviously share this presentation with everyone. But jumping into there's two questions that have gotten asked a ton, and I'm very curious to hear your perspective on it, Michael. The first question is, this is, from someone. They said, we've built a successful, solid advisory practice, but scaling it has been challenging. How do you maintain quality and consistency when you're growing your team beyond the original senior experts who built your methodology?
Oh, that's a really great question.
Yeah.
And I want to tell you, I want to tell you that we've had this challenge, we have this challenge, and we'll continue to, because you
Yeah.
are dealing with human beings.
Yeah.
Your advisors are humans. They're not robots, right? They're not pieces of software. So I would start with, okay, what kind of cadence or rhythm of meeting do you have with all the advisors? Most of the firms I know, they hire advisors, they kind of let them loose, and there's no like team being built amongst the advisors. Like, hey, we're an advisory team. These clients are the businesses or the firm's clients. They're not Michael's clients.
Hmm.
A lot of advisors that come in, especially if you have contract or part-time advisors, they view these clients as their clients. And you got to continue to reestablish a meeting cadence of, hey, what's the big vision you're trying to give them? What is reconciled as an advisor on our advisory group? What are we trying to build? What kind of scale are we trying to have? What kind of clients are we trying to serve? And what is the actual advisor experience we want every client to have? And the ultimate goal is, it shouldn't matter which advisor they meet with at your team. It should be a similar experience, a similar value, similar deliverables, and the client should leave the experience with a similarity of, okay, it doesn't matter if I work with Michael or Fady, I'm getting the same value out of this. If it varies, which it's going to have some of it, some is going to vary because it's a different human being, but if it varies a lot, then you're gonna have a problem, because you can't that's not the definition of scale. That's a boutique advisory firm,
Yeah.
right? So you want to start with just, how often are you meeting? Are you giving a common vision? Do you share a common vision? And you're gonna have some advisors that they're not about that. They are on a solo journey. You happen to be the part of the journey, but they're really representing themselves. And if you're trying to scale a brand or advisory philosophy, they're not going to be a great fit. You want ones that are bought into your vision, your brand, your methodology. And then second is, whether you use software or not, take a look at your processes. How are you onboarding the client? What's the client's experience in the first 30 to 90 days? What kind of models are they being exposed to? Is it a same model or different models? Uh, do you, as a firm, if you have a niche, even in the niche, I've seen firms still have wildly different experiences for their clients. So look at all of that process and go, okay, is the client experiencing a similar process and journey throughout the whole advisory life cycle from start to finish to completion, and what value are they getting in the middle? And then third is it a system? Is it a philosophy? Whatever, what is it that's consistent? If it's a system, get everybody trained on it and get everybody bought in. So whether it's Clockwork or something else, you got to get everybody bought into what is the system, and how are the reports going to come out, and then what's the meeting cadence. I would even go far as saying, hey, here's the standard agenda advisor I want you to have with every client. When you meet with them, I want the standard agenda. Now, they can put their flavor and taste into it, but they should be able to experience the same thing with every other advisor on your team. So that's hopefully it answers in regards to scale. Most firms aren't doing scale; they're just doing custom because it is very difficult, and we still are working out our kinks over at Reconciled as well. So
Yeah. No, I mean, all that's invaluable experience stories. The number one thing that I will say that I'll add on to that is like use your existing staff. So many people
yes,
try and think like oh, we have these experts, these CFOs. They are the worst people to scale advisory because I know as a CFO, like as a former CFO, no one could build a financial model better than I could.
yeah.
And trying to create another person who could do my model is close to impossible. So use your existing staff, use your lower level team members, your bookkeepers, your controllers, use them. We've seen implementation for firms that have these senior experts not go anywhere. And they come on and they sign up and they get 20 clients and they stay on 20 clients. We've seen other firms that are controller and bookkeeping firms, they blow up because they really lean into it. And then their lower level staff grow into the advisory. You don't need to be a quote unquote CFO to be doing advisory. Like as a bookkeeper, you could be doing advisory and you probably already are. You just aren't charging for it, but that's a different story. But use your existing staff. Don't go hire people. Don't go, you don't need to over engineer it. Just make sure that you have some sort of standardization, which is, obviously key for scale. And in the minute and a half that we have left, I think we have some time for overtime. If Michael, if you have time, or if other people want to kind of hang on, this is another really, really good question. We're trying to move up market to larger clients, but the complexity increases exponentially. What specific changes did you make to your advisory approach when serving businesses with 20 million and more in revenue versus your smaller clients?
Yeah. So generally speaking, when you're talking about, I would call a mid-market client. Okay. There are a few things that are going to change. One is mid-market clients, generally speaking, they're going to be on systems like Sage Intacct, NetSuite, some of the larger mid-market systems. You're going to have to get used to some of the FP&A systems that fit with those, right? That fit with those systems. But also, you're going to have to spend more time analyzing the data because they're at those larger companies, especially if they're fast growing. There's going to be a lot of error on some of that data being fed into your model. So definitely spend more time, and that client, whether you're doing the bookkeeping in-house or that you're going to be overseeing and interfacing with the bookkeeping team, accounting team at the client, you're going to want to get that know that team really well. That's really, really important because I find at the mid-market, your relationship as an advisor with that team makes or break your ability to get the right data, to get it fast enough, to get it accurate, and also to help them make the changes you want there. You're probably going to be involved with or in the middle of a system implementation. Oftentimes, those clients are going to be graduating from QuickBooks or Xero, and they're going to be asking you to get involved in an ERP implementation. So that's another thing. And then third is financial, like cash flow and financial analysis and capital is like key for a company that size and growing to, let's say, from 20 million to 30, 40, 50 million. They're trying to get to 100 million. The mid-market range is a much smaller segment than small business. Looking at working capital and cash flow and looking at access to capital is hugely important for most of those clients because they're generally growing very fast, or just capital in general and their capital life cycle is going to be really, really complicated. So you understanding the drivers of what does their turnover look like? How often is their AR turning over? Do they have a large amounts of AR? Are you doing anything to help them keep their AR down so their cash is coming in on a regular basis? What do you know their DSCR, right? All those things are going to be super, super important for a mid-market client. You're also going to see that your advisory is going to have to level up at some level. Those companies usually have more sophisticated boards, or they're going to start going for that. If they get a large Series B or C investment at that size or D, or they're going to go for sale, you're going to have to be more sophisticated in the way you present. Your decks and your presentations are going to be more sophisticated. So those are all things that happen,
Yeah.
at that
I,
level.
I love all that. And we're a minute and 45 seconds over. So I'll kind of do a closing now, and really, the Q&A obviously is extremely valuable. So if someone wants to kind of hang on, we can. We'll be sending out the slides and the recording tomorrow. Make sure from a Clockwork side, we are running a tax season promotion. Let us know if that's something that you would like to get set up on or interested about. If you're interested in checking out Clockwork, you can literally sign up for free. It'll take you 3 minutes. Integrate. If you have less than clients, literally you can use Clockwork for free. And if you already have a CAS function, book time. We're more than happy to walk you through all the stuff where we can actually do some pretty cool things on the tax season promo to get you guys up and running. Aaron will also be dropping links in the chat for our LinkedIn group. We have a CAS collective group. Again, that's another no pitch zone. It's not a Clockwork kind of thing. It is where a bunch of CAS executives and professionals go in, share some insights, and share more things around everything CAS. Michael, anything on your side?
Oh, that's great. Just connect with me on LinkedIn. Happy to talk and help with anybody. I know a lot of this through making a lot of mistakes.
Yeah.
So I want to help any of you not making mistakes, but also, a lot of this too as well. And we didn't talk about this is the soft skills. It's not just about numbers. It really is the soft skills in your relationship with your client.
Yep. Yep. You're absolutely right. All right. Well, thank you everyone for attending. Thank you so much, Michael. As always, this is awesome hanging out with you and talking
Patty,
shop.
I appreciate it.
All right. Thanks, everyone.